As I stand here in front of the Delta Grand Hotel, it reminds me of a number of years ago when my wife and I were young adults. We had the opportunity to run her family's hotel. Her mum and dad needed a break, and so Jackie, fresh out of catering college, had the opportunity to run a beautiful Victorian stately home. I think that we did the best job that we could as young adults, to be very honest. We had a good time, we enjoyed it, we ran the hotel. But there was one thing that I always feel a little guilty about. As we were looking after the hotel, I had a phone call. It was for Jackie's father, and the gentleman on the other end was a stockbroker, and he was telling me that he had a fantastic deal for Jackie's father. He had a great stock promotion opportunity for a bioengineering company, or a biogenetics company. I think it was called Infogene. And for only $320, Jackie's father could invest in some shares in Infogene, and it would be sure to make him rich. Well, I was just about to propose to Jackie, and so I figured that would be a cool deal to be able to retire his daughter early once we were married. And so I very quickly signed up a subscription agreement, and I did tell him about it, but I made sure I got mine in first because they were guaranteed to sell so quickly. Well, today my Infogene shares actually don't exist any longer. It's another company called Zantech, I think, and if I'm not mistaken, they could be worth a total of $1. So I can honestly tell you that my investment in the stock market didn't work too well at that particular time. However, the good news is an investment in real estate can be a lot better than that in the long run. So I thought I'd bring you to the place where realtors get their statistics, the Okanagan Mainline Real Estate Board. You know, I've always thought about how people secure their future wealth and the options that they do have, and to me, real estate has always been a very viable option for me and my family. And of course, being in the real estate business, I can always recommend the positive aspects as well as the negative aspects. So I wanted to look at some facts to be able to help you determine what you think about real estate investing for your future security. In my experience, if you had invested the same $350 that I invested in real estate, unless you're in some far off developing country, it's near impossible that that investment over the last 30 years would have dwindled to roughly $1. So what I wanted to do is to show you some of the actual statistics as to what's happened, and let's take a look at the stock market and see where it's gone to. And I'm going to use the last 10 years as a frame of reference to be able to do that. So what we did is we took a look at the last 10 years history in regards to the median value of homes in the Kelowna marketplace. What we found was very, very interesting. In 2002, if you'd have bought a single family home, the value was $170,000, the median value, whereas in 2012 that median value had jumped to $407,000. That's an annualized growth rate of close to 9.1%. If we take a look at strata apartments like the ones behind me, in 2002 the median value was $92,000, and in 2012 it had jumped to $233,000, giving you an annual yield over 10 years of about 9.7%, really quite a good performer, to be very frank. Strata townhomes, on the other hand, were probably the top performers in the segments that we looked at. In fact, in 2002 you would have seen a median value of $114,500. In 2012 that had jumped to $319,900. That's an annualized return of 10.8%. Very difficult to find, to be very honest, even in a good economy. So, if you're looking to make an investment, whether it's real estate or in the stock market, many people make that investment based on what will be a rate of return, essentially. That means that you look at the value that you purchase the asset at, and then you look at the value that potentially you could sell the asset at. And that's how we've analyzed these facts, is the real estate market at the time. In order to evaluate that growth, the very simple math is really what we call the rule of 72s, or the law of 72s. And that means that you divide the annual rate of return into 72 to see how long it would take for your asset to double in value. As a very simple example, if you can get a 7.2% rate of return, your money would be worth twice what it is today in 10 years' time. 10 times 7.2 is 72, the rule of 72. So it's very simple to analyze it on that basis. If we take a look at the stock market in 2002, the TSX is an index, and most people will invest in a fund, whether it's an index fund or a mutual fund. They'll invest in something that's managed to make their life easy. If we look at the TSX in 2002, it was hovering around about 8,000 points. If you look at it in the last couple of days, it's been around 11,300. And that shows roughly annual interest return of 3.6%, a far cry from real estate. So if you're a young entrepreneur, or if you're a young family and you've just decided that you need to look at your financial planning and your future, then certainly an important element of your portfolio might be a real estate investment. Of course, one of the great things about owning a home, a principal residence, is it's sheltered from tax. There's no tax gains on the value of your principal residence here in Canada. That's a huge benefit for all of us. Having said that, the house is also the place that you buy to live in, not necessarily the investment. But for Jackie and I, my wife and I, we've always stretched a little bit and bought maybe a little bit more than we should have done in terms of value, and benefited from the fact that it improved in value along the way. So it certainly can be part of your financial strategy. So for those of you who are asking, what did my father-in-law do? In actual fact, he didn't buy the Infogene stocks at all. I was the only one who fell for that. And in fact, his piggy bank is a lot larger than mine is today, unfortunately. So I'm going to stick with the real estate.